This one will be more around price action as well as stock options. Very basic at stock options, just to make sure we have enough knowledge to get our hands wet there. You may have to research deeper into the stock options. And anything with price actions, we can get into the practical aspect of it on charts and how do we really get price action decisions made, triggers wise, going long, going short, and then also minimizing the use of technical indicators so we can keep probably one or two just for basic guidelines, and the rest of it will all be price action. Price action is more real-time, instant action of price, whereas technical indicators will be more around lagging information. If you do a moving averages, you're calculating the average of the last 5 bars, so the price may move 5 bars if I take the daily chart, but price may move considerably away from the moving averages. So you may hit into some losses at the same time profits too, where you'll have to watch out on lagging indicators and how you intend to apply your stop losses and take profits. But let's get into the stock option basics. Looks like there is some awareness of stock options on our side here, but let's get into the very basic and see if there are any links that can help with additional training, as well as how do you make certain decisions, strategies around that. We will not get into deep strategies or anything in options trading. This is just to get an idea on what kind of options to take, what are the basics you need to understand, and how do you place basic call options or put options, and where can you use these as benefits in different accounts like cash accounts, or if it is taxable, non-taxable retirement accounts kind of a thing. And we could probably touch a little bit on margin too, and how leverage can be used in our favor versus how it can damage the portfolio too. And what kind of risk can we consider using options, and how do we have to manage that risk? All right, so let's get started on the first one here, stocks versus options. Right, this is always the question, do I do stocks? Do I do options? A lot of people would start with stocks and then eventually would go on to options because there's a lot more profit with options, but not knowing all of the basics and the risk that options come with, you end up learning lessons there, losing out a lot of money because options is high risk. And generally what I say is if you're doing basic options, call options, put options, you first have to learn how to make money on stocks. If you cannot make money on stocks, then don't expect to make money on options with basic strategies there. But if you get into other ones like spreads, covered calls, and there are several other strategies there, like the iron condor and straddles and the whole thing. But before we get to that point, you should get a bit comfortable with regular stocks, get into the basics of options before you get into any complicated things, and understand in-depth stock options and how to exercise them. So here are all the basic components related to stocks. So at a high level, right, if you have to understand stocks, we all know this, it's directional. Either you go long, either you go short. A lot of people do not know short, so we can ignore that. Let's say long direction, that means you buy 100 shares of so-and-so company, it goes up, and then you are not forced to get out of the stock or anything. You can keep it until as long as you want, swing trade, day trade, do whatever you want. There is not much other than locking your capital into buying those stocks if it is losing or making money. It is safe. There is less risk involved if you know what's happening. But options is not like that. It goes off of time, and it has an expiry date to that. If those options are not executed by the time the options expire, you lose out everything that you've invested, right? It's not like you can buy and hold strategy. You just leave it there forever. No, options is more of borrowed stock, that you say, I have to buy 100 shares of Apple, for example, and it costs you so many dollars. But then if you use options, it's more borrowed, it's leased stock for a period of time. So your investment will be low and your returns could be higher too. Let's look at the numbers towards the end, but let's get the terminology first taken care of. So type of, okay, let's also see what else. So on options, there's more ways of making money. aside from the leverage that it comes with, the volatility and the time decay and all of those aspects, there are multiple ways of making money. In stocks, it has to go up if you're on long direction, or if you short, it has to go down. But in options, you can also make money if it goes sideways, right? There are different strategies for that, but that comes with more education, more experience with stock options. You'll have to work on the volatility aspect. There's a lot of factors that come into the picture, and see how do you apply this implied volatility, and how low is it if it has to go sideways, and how do you make money on the premium, versus if you're trying to aim for it to be very bullish or very bearish, right? And how do you do that? And then there are other factors like at the money, in the money, out of the money. When do you go out of the money? When is it in the money, at the money? You need to be careful with all those aspects, because it comes to the different premium that you pay with. So you'll have to be really careful. So leverage is one thing. If you have to control 100 shares of a certain company, right, you don't have to spend all of the money that goes with the 100 shares. You can as well take only a certain amount, maybe like 10% to 20% of the value. It depends on the premium that's associated to that. And it also depends on the interest, the implied volatility, the cost of the option may vary. Let's say if you have to buy 100 shares, I keep saying 100 shares because the size of a contract, the minimum size of a contract for options to purchase is one contract. And one contract will allow you to control 100 shares of stock. So if you were to buy, let's say, something that's trading at $50, and it is 100 shares, so you will have to end up spending $5,000 on that particular stock if you have to buy 100 shares of that stock. But if it is on options, you may only do a fractional amount of that and get into the trade and still be able to control 100 shares of that stock. Now, how do you profit from that with that fractional amount? That is where your leverage kicks in, and that's where your profits kick in there, right? On if the percentage of move on the stock market is maybe 10% for that stock, your options move will be a lot more than that. So that's the benefit, or that's the advantage of leverage. And the leverage can also act, it will act in your favor, but it can also act against you. So your risk will be high. And there are ways to identify what is the risk. And there are some tools that the brokerage could give, like TD Ameritrade gives something called a probability column there that shows you the probability of your outcome. Is it 50%, 60%? And for those that are not on TD Ameritrade and you don't have this column there, you could use another Greek alphabet. They call it as delta. And that's towards the bottom of the screen here. That could be also used to see how much can you actually probably make for every dollar move that happens on the stock. So where did we miss? Premium, right? Let's go back to premium here. Intrinsic versus the extrinsic value. Intrinsic is nothing but the difference between the stock price and the strike price, right? So when we talked about the at the money, in the money, and out of the money, you'll have to spend more time on that in understanding what they mean. At the money is where the stock price is equal to the strike price. Right? And that is where that is the balance line. And if you go in terms of a call contract and you're trying to buy a call, that means you want to go long on a call. You're expecting for that stock, let's say Apple is at $100 and you are expecting that to raise up to $120 or something, right? Then you want to buy a long call. And to buy a long call, there are different components that go with it. You will have to say, what is your strike price going to be? Your strike price is going to be at the money, where your stock price is about the same as the strike price. When it is at that level, if you're more or less at the break-even point when you're entering. And that is where the most volume generally is. There's a certain period, there's an expiry date for the contract. So the closer it keeps going to the expiry date, it's like any products when you go to a grocery stores on the shelf, the closer it gets to the expiry date, you could clearly see discounts coming in, your coupons coming in. You want to get rid of it as quickly as possible. Otherwise, you're not making any money out of it. Same thing here. When the option gets closer to the expiry date, that is when you will see that time decay kicking in and the option value, the premium keeps declining, right? So those are factors you have to be really careful. You have to start small, play around a little bit, understand it, feel it before you get into any deep option strategies. Expiration date we talked about. We look at the profit and loss aspect of it too, and what you could do with regular stock purchases versus how you can make profits and how you can lose money with stock options. Volatility is one other thing that you have to be really careful about. If there is not enough volatility, then there is not much movement in the market, and there are different strategies if the volatility is low versus volatility being high. And if you're trying for basic strategies only for long call options or short options, shouldn't say short option, but put options, to expecting that the stock will go down, then that is where you need to watch for volatility. And if you go with high volatility options there in the stock, you will have to know that the premium will be high too at the same time. General calculation about volatility, implied volatility specifically, this is already a calculated number provided by the brokerages. Take a look at this number. It generally represents like one standard deviation for about 1 year period. So if you notice, we'll have to get into more in depth if you have to get into that stock options to see how the normal distribution curve is spread out and how the standard deviation is kicking. Most part from where the mean stands on the normal distribution, it is like the plus or minus 38% that 34% that kicks in, comprises of roughly about 68% of the move that generally happens. And this implied volatility shows that particular number of what that 68% will represent. If that implied volatility is too low, that means the market's not going to move much, or the stock is not going to move much. If it is high, then there is a good possibility that it can go plus that much or minus that much. So depending on your strategy, you go with implied volatility. But if you're only aiming for long positions or short positions, aim for something that is reasonable, not overboard, not too low, because it comes to the price if it is a high volatility number. Okay, let's see, time decay we talked about, delta we talked about, and make sure there's enough liquidity. When we talk about liquidity, you will have to look for regular shares, at least about 100,000 in volume before you can start using options on those. That is one of the basic things I look for. And anything on options, roughly about 100 to 200 at the money maybe on volume on options. And if you're looking at open interest is again something that is more than 1,000 maybe. Well, the difference between volume and open interest will come at a point where volume just is an incremental number, whereas the open interest is more of a difference between what is put in, what is taken out, and that kind of a number is the open interest. And the higher the open interest, there is more movement, there's more interest in the market, and that is where you can get in and out with ease. And the spread during that time will also be low. Spread is one of the concerns that you'll have to watch for with options, because if there is not much happening there, your spread would be too high. Your spread is the value between your ask and bid. So if you're trying to get in, you'll get it in ask price. If you're trying to get out, you'll get out on a bid price. If those numbers are way too far, you're already starting with a negative value there. That's high level, the basics around the stock options. And there are some useful links here. Tastytrade.com is one of the very popular ones. They only do stock options trading, if you've not heard about them. Optionsprofitcalculator.com is another one that I used to when I got started. Let me pull that up to see if you get an idea. This will clearly give you an idea on where you enter, how much profit you might make, how much loss you might make. So this will give us a good representation before we get in, especially when you're learning options, you get an idea. It is not 100% accurate sometimes that I've noticed, but you will always see this one. So let me go back here. What I did is, this is options profit calculator here, and they will let you choose. Are you able to see my screen here on the options profit
Yeah,
calculator? All right,
yeah,
cool.
we can see.
Yes.
Cool. So here, what you can see is you can pick up the strategies that you want to see. Oh, these are all the strategies that you have. These are the basic ones, right? Like out calls and long put, so and so. And this is where one of you was talking about the spreads. How do you do the credit spread and all that? Then advanced will come into the butterflies and the the iron condors and straddles and strangles and the whole thing. And if you have to go custom legs, etc. The the benefit of with a lot of commissions being changed, this has probably become more of uh, a trading channel. Like a lot of people started using them, but it comes with a lot of risks. So education is critical on this. So what I did is, let me take SPY, right? This is generally what I take because this is the market benchmark S&P 500 index. So if you take SPY and just say get price, it'll get you the value, the current stock price that is out there. And here you want to say buy, and you may want to select the option. And this is where all the terminology that I used with at the money, in the money, all that will come into the picture. Let's take a look at that. So one other thing I missed mentioning is the expiry date, the kind of options that you have. If it is a highly traded, high frequency, shouldn't say high frequency, but highly like high volume trading on any companies, on any stocks, you also have weekly options. Expiration date generally is the third Friday of the month, and you can get to choose either in, what is it, September, right? Yeah, October, November, December, every month, and then it will expire on the third Friday. But there are also weekly options, and something that is major like SPY. This is one of the top stock options symbol on SPY. So you can also do weekly options where the options will end on a Friday, on each Friday. So you can execute within that week for swing trading and get out of options. The longer time that you take, the higher the premium it gets with the extrinsic value, because the longer the duration you are taking these options for, the price will go up because of the time value in there. And that is the time value you keep losing as you progress, because the longer you take, let's say you take some leaps and stuff like Pargat was saying about 2022, that is where we have a problem with paying a higher premium, but at the same time, there is also a benefit in holding those long ones depending on how your strategies are. So let's scroll down here. Okay, so this is a separate window. Let's scroll down here, and the strike price, I'm going to minimize this so you can see that here. SPY, right? And your current price is $334. If you look at these columns, let me see, there is a bid, mid, and ask, right? So ask is what you will do when you're doing a buy. So let's go down, let's go up to 300. Generally, you do not see so many options on your brokerage, but you can always expand that to see that. You see this gray highlight that is here. Slowly the gray highlight here on the right side kind of fades off. And then on the left side, if you see, the gray is a different color. So that is the point where it says I'm in the money, 334.07, right? So that is where they round that number. This is your strike price, which is at the money, 334. Generally, left side is the calls and the right side is the puts. So if you scroll up here, here's the puts, here is the calls, and here is what you select, which particular expiry date you want to pick. So let's say I want to pick about 18th December, right? That's how I have selected here. 18th December is the probably the third Friday or something in December, but those are the monthly options. Come down here close to at the money, right? What I want you to see is this is 334, close to the stock price, 334. This is at the money. As the value goes up, right? 335, 36, 37, 38, 39, 40, all of these, right? This is where you will notice your options here, 1606. These are all the different bid and ask. Let's only look at the ask price because this is what you're going to get it for. See, if you look at this one, as you're going out of the money, right, the price value is going out of the money, right? And that is where you will see the price is going down on the call options. So out of the money, in the money, at the money is different. Shouldn't say at the money, but the other two are different for puts and calls. For puts, out of the money is on the top where the value goes down because now you're expecting that stock to go down, right? So 334 is in the money for call options, and anything in the money, if you don't think the volatility is too high and if you're only doing a swing trade and you expect that you will be getting out fast, I will stick to in the money options, right? Then it also depends on implied volatility and a few more factors here, but most of the time you tend to be at the money. But if you think it's going to be a really great one, their earnings are coming up, and you know it's going to be exceptional, you did all the research and everything, you could go out of the money and pick something that is cheaper because your returns will be way high. We will see how the results will look like. But at the money right now is $16.72. Two things to compare here. One is if you buy 100 shares of SPY, it is going to cost you right now $334 multiplied by 100, right? So that is like $33,400. But if you have to control the same 100 shares of stock, you get it for $16.72. You still multiply by 100 because each contract is 100 shares. So 1672 multiplied by 100 is 1,672. So you can control the same 100 shares of that stock with $1,672 compared to $33,400. I think last time when we discussed, I talked about how I was able to get into Amazon. Amazon gets a little expensive because the stock price on that one is way high, but it gets expensive too. It does not stay at $16; it go way high. So each one of them, each contract or so, when I purchased last time, explained that one was was about 18,000 or 19,000 or something on each contract. And the returns that you will get is very high too, depending on how you time the market, either by price action or technical indicators, fundamental analysis, whichever direction you go. It was the returns last time were about 25,000 or something. It was 125,000, 125% return or so. But imagine if it goes the other way around, it goes a lot faster down, including the time decay that also adds up to that. So you'll have to be really careful when to enter, when to exit. The only time I use basic long call options is when the stock price is too high and you want to get in and out fast, and you know when your exits are, where your entries and exits, your stop losses, take profits, all that is defined, right? That is the only time you enter into stock options with a perfect plan. If you go on a buy and hold strategy, like most of them do without any direction, options is definitely not a thing to do. So we talked about at the money, and for the calls, call options, the at the money is when the price goes down. And once I select one of these, then we go into the results. We will see how the results are going to be, what the profits and losses would be. So for now, understand at the money 334, which is the strike price, which is the stock price too, right here. And then if it goes lower than that, then you're trying to buy an option which is less than the current stock price, and the option value, the premium will keep increasing. But if you go out of the money, then it will go when it'll get cheaper. Same thing here on the stock price when it is 334 and you're trying to buy a put. When you say buy a put, that means you're expecting for SPY to lose money, to go short, right? To go downward. So if it goes downward, now the whole thing reverses on the put options. If you see the money, the one here is considered out of the money and it's cheap, and the one here is in the money and this one is expensive, right? So let's take at the money for now at 1613 or say 1672 here for a call option, hoping for this to go long. So this is where you will notice I've selected 18 December, 334 is the strike price, right? With a call option. And the price per option is 1672. How many contracts am I applying to buy? Like I said, your contracts minimum is one contract and it is multiplied by 100 shares, right? And your cost is going to be 1,672. And this is standard here, add calculation new tab. So you hit the calculate button. This is what comes up, right? So look at the reds and look at the greens. And this is where your in the money, out of the money will play into. If, let's go a bit slow here. So call options, right? So here is what it says. Your maximum risk is 1,672 at a price of $334, right, at expiry. That's the maximum. That means it's not executed. You let it expire, everything, all of the money that you put in. This is the maximum loss that you'll go through. It doesn't matter how far low the S&P 500 goes. Your maximum loss is going to be only 1,672, but you're controlling 100 shares. There is no obligation that you have to stick until the expiry date. Anytime you want to get out, there is no restriction for you to hang on to that. You can buy a few minutes later, you can also sell it. So estimated returns, SPY, right, at 334.07 on so and so. This is the entire list that they're giving. Maximum return, you can't really define it. The higher it goes, the more money you make before that expiry kicks in, right? Break even at the time of expiry, you'll have to watch out. If it does not hit $350 at the time of expiry, that means you're actually losing money because of the time decay that happens into that, and the premiums go down as it gets closer to the expiry date. Let's go back into this one here. 334 is where our entry was. This is our strike price. So that is where this line is to say 334, roughly the mark. They have it with the $5 difference here on the chart. And keep watching from left to right, starting from September 14, because we are roughly on the Monday here. And then October, November, December, because this is where the expiry is, right? And let's start from here, 334 upwards. This is where you make your money if it goes upward, but this is where you lose money if it goes downwards. So if you took anything out of the money, right, like a 310 or so, you are going to start negative already, right? Because the intrinsic value there is the difference between the stock price and the strike price, and it's going to start with a negative value. But if this value actually moves up and goes to 400, your returns will be way higher. And if you start from here, from 335, look, let's say we went into October, right? In one day, we don't expect it to jump to 400. So let's go in a diagonal fashion. Let's say from 335, you know what best will be is, let me take S&P 500. Let me put S&P 500 and show you the chart first. Let me see if I can do this so you understand what I'm talking about. SPY. Now I'm going to bring that chart over here. This will give you a good idea what's going on. This is our chart from S&P 500, SPY. This is a 5-minute chart. Let me switch this to like a 1-day chart here. Right. This is the daily chart. And if you look at this price here, 334.06, right? And that is where our strike price was. That's why we're calling it at the money. So the market took a beating right from the September 2nd top onwards all the way down. Now, if we are expecting for it to go back up to the peak where it was, let's say from 334, now it goes back to the top, which is roughly about 357 or so, right? So if it has to go to 357, and that is what we're hoping for, let's go back to our options here and say, right now I'm at 335. I'm hoping for it to go back to 357, we say. Let's say this takes a few days into somewhere mid-October, right? So if 334 strike price goes up to the strike price of 360 in a matter of a month, right? You made $1,408. And that is going to be 84% profit on your stock options. But if you really look at how much it actually made from 334 to 360, right? 1% is roughly about $3. So it's, let's say it's moved there. So the actual move is only 10% from 335 to 360, but on options, the leverage that you're getting, say 84%. And instead, if it continues to go, because you have it until December, and if it continues to go higher in November, let's say it hit 385, right? In this part, you are at 3,460, 200%. Now, what I want you to see is at the same time, if it continues to go down instead of going up, let's go downwards this way, right? The same October, right? And from 335, the same percentage when it goes down here, roughly, you will see that you lost. It's easy to lose that much amount. You see the numbers out here. These numbers are nothing but the percentages. And you will see not too far, if it goes down a little bit, you're already down by 60%, 50% within 2 weeks time frame, only if it drops from 330 to 315, right? 57. So that is the kind of leverage, that's the kind of benefit that you will have, and that's the same kind of risk that you will have to account for. In 2 weeks, if it drops about 305 right here, you lost 74% of your investment. So that is 1,238 negative, right? So this is a tool that will clearly help us understand how much you could potentially make versus how much you would lose, and where do you have to track, when do you get out, how much losses that you're willing to take versus, how far do you sit on the trade, and watch out for fundamental analysis, market research, how we want to do. We are following the market direction strategy as one of the baselines that we're using. If we use that and follow stock options only on SPY, that itself is a strategy. Let me pull up, this is probably a good segue to pull up our market direction and how I use this, right? So let me pull this up here and keep it clean. So I'm going to get rid of some of the stuff here, so this chart stays as clean as possible. Be able to see the my chart here on SPY?
Yeah.
Cool. So this is the chart on top. This is the candlestick pattern, right? So this is what I publish on our group to say what is the market direction. These top three represent the NYSE, and these bottom ones represent the NASDAQ, right? So if you look at the only the NASDAQ, only one of these lines, I publish all these 6 colors for you, right? In the group, only if you take NASDAQ as the starting point was here, the date will be in the bottom here, just FYI. If you go 325 onwards, all the way until 611, it was upwards. For a few days, it showed downwards, and then it got back up on June 16th onwards, all the way until 9-3. What I want you to gauge from only this one particular line, right? If we entered somewhere here, 616, and exited and 9-3, based on this strategy and market direction that we have, 616 is roughly here, right? So 312 is the price. On the right side on the chart is the 312 price, right? And if you exited right here at 344, not even there, right? If we do this, let's say we exited right here, 344, 312 to 344, you're roughly looking at a $30 difference. Yes. So if we go back here and see the $30 difference, roughly, right? It's not the exact percent, but if you look at 334 to $30 difference at a 360 here, and you bought deep enough options, this is where you would move out percentage wise, right? Only trading S&P 500 and going in that direction, your profits would have easily been about 100% and up, right? And when people are confused what to do, I just stick to S&P 500. You can also do like the TQQQ, because their returns will be higher too. So let's say if you do TQQQ on the same market direction we have here, starting from here, look at this one, 93.90, all the way up to here to the spot. 93.90 to 150 is almost 50% there, only on one symbol and going off of the market direction. So doing a combination of things, how do you use market direction with stock options to benefit only off of the S&P 500 using the options profit calculator? And you can see all the greens that you have here is the profit that you make, and all the reds that you have is the losses that you could potentially get into. And watch out for all of the other terms that we use, your expiration date, your implied volatility. You don't really have to monitor for implied volatility, volume, and all that if you do SPY, because it's always going to be enough volume, enough volatility for us to get in and out with ease and be in the right profit zone, because the expense, the overhead on these will be low too at the same time, because it's one of the highly traded symbols. All right, so that was about stock options and a bit of our market directions. It's been a while that we touched the market direction, but just for those that are not familiar, this is what we use that I publish on the stock market side, on the market direction side. So you get to see what are the colors that I'm publishing, right? So all of these turned red somewhere in this time frame here. And this is where we either get out or get into the short direction to kind of capture the profits in this side, or go in cash so you don't go into a lot of losses. We've seen different opinions on the chat on people saying, I am a buy and hold person. You know what, I would not worry about stock market going down. It's going to kick back up and all that. You know, that's one form, one opinion. But if you look at market direction here, exactly during our February timeframe, right? Same thing happened when all of these lined up to red. It was right here. For those that are in buy and hold, have taken all of these losses, get into panic mode, right? A lot of them made wrong decisions here. And then when the market picked back up, they were not actually in the trade. It's easy to say buy and hold is good, but buy and hold takes a lot of mental stress there. If you're not able to control it right at this point, then you are losing out. So if you're able to capture these, either go into cash and start back your profits right here is the best option, or you can also go short here, take all these profits and then get back in long direction. So that's profits on both sides. Right. So questions at this point?
I think on options, only thing what I think about after listening is that you have to really do good analysis on the ticker what you want to do trading. I mean trade options on. Definitely a great analysis is required unless and until you are 100% sure, because the profit is equivalent to, I mean the loss is more than the profit. What I'm seeing.
No, like depends on different strategies that we have there. If you use some strategies that are both direction, it can also be used for hedging purposes, for insurance purposes. Sometimes there are different reasons why the option strategies are used. The only one that I explain here is a straightforward buy instead of buying stock of 100 shares. If you were to control the same 100 shares using the long call options, what would the results be? But if you're doing it for different purposes, like spread purposes, you pick something that is implied volatility is too low and not expecting too much of a movement, right? There's different other strategies that you can use. And covered call is another one that is one of the basic strategies again, but I don't like that combination personally myself, but there are people that like that. And one of the other ones is also if the implied volatility is too low and we know that the market's not going to, the stock's not going to move too far off of a certain range, then there are also ways to make sure you buy these options or you get into these options, but let it expire so you keep the premiums. Right? So there's multiple reasons, multiple ways of profiting from it. It's a lot more into educations, but this is the basic. If you can gather up all of this information and say, all right, these are the points that I need to be worried about and to learn about. Here are the basics on terminology. You need to know how the leverage works. What is your premium? What are you paying for, right? Understanding those and the types where you have your calls, your puts, how does the leverage work? in your favor, against you? What's the expiration date? How close can you go to the expiration date? I do not go all the way until the expiration date. I close it a few weeks before the expiration date kicks in, because from there, I personally feel that the time decay is more rapid, and I do not want to wait until the expiration date or even close to the expiration date.
That's
Even though
why
you,
I'm mostly trying to learn the credit spread so that we can be casino, not a player. Because then time is our friend in that case, right? So
Exactly, that is critical. Delta is also critical, but if you have that probability component on the Thinkorswim platform that you're using, which is pretty close to Delta, but otherwise try to get familiar with Delta. Liquidity is very important. You don't want to get into anything out there and not be able to get out. And you also have to watch out for acquisitions and the mergers, acquisitions, any kind of splits and all that is happening. It could work in your favor. It could also go against you. I've burnt my fingers a couple of times where I didn't realize that the company was getting bought out, and then your options stay lingering out there. You lose out all the money. Part of that, you don't get anything after that deal is complete. So you'll have to watch out on those days and the events, the company events that are happening, if it's going to work in your favor or against, and then how soon do you exit. It's not like one of those, you put it in there and forget about it for a few years and you think it's not meant for a buy and hold kind of people.
so options is definitely like, so there is a minimum time. What is the minimum time frame, please?
You can do weekly options by the week, but you can do monthly options. The longer term options are called leaps, that you can go do like a multi-year thing, but then your premiums will go higher too at the same time, because you're looking for options at an extended time frame.
Got it. And you can do in short direction also for
Yes. So one of the other things, good point that you brought up here. One main things I use short options, or when I do buying a put, right? Buying a put means you're expecting the stock value to go down. That's where you make money, right? And one of the main accounts that I use this is on the retirement accounts. Retirement accounts does not allow you to go short. You cannot do a short sell on a retirement account. It is prohibited. But at the same time, if you have options as open for your trading on your retirement account, it is still a buy, but it's a put. So if you do a buy on a put option, you are technically going on a short sell. So if I have to take SPY on this example that I gave you, and I do a buy for a put option, and you can still make money when the market's going downwards, even though your retirement accounts are prohibited from doing short sells. Since it is a buy operation on a put option, you're still able to get the benefit of making money in the short direction.
Got it. Okay. Yeah. So based on market direction, we can definitely calculate that and do that.
Oh yeah, I do this. One of the retirement accounts that I have is purely based on market direction, but I don't use options on that one. That one has the privilege of doing futures. So I directly use futures there and do a short on the futures. So one of my retirement accounts is purely on market direction and purely on futures. I don't do any stocks, nothing in that one. And the returns are pretty reasonable until now. From the time we've started, I've been doing that on the side there, only for market direction, just to make sure I'm comfortable. What I'm trying to tell the group is the same that I'm also practicing. So on that account, I do only market direction and only futures. Only one instrument that I play with. No stocks, nothing in there, and it's doing really good. If you look at this. If you look at this one, right, and the way it's moving from June, the way it moved from March onwards, you just sit on the futures, because futures also have expiration date, and it's not as complicated as options is with all this time decay and everything else that you'll have to look for. Get into futures, buy futures right here and stay in it as long as it shows long direction, and then Now I flipped it. I'm in the short direction right now. If it continues to go down, the retirement market is also account is also making money there.
Okay.
Cool. So thoughts, questions, anything that you've explored? I don't want to get too deep into any option strategies here and confuse people, but wanted to make sure we cover the basics and the risk that it comes with and the useful links. If you have to try before you try it, what kind of risk there would be, what are your exit points, and the basic options trading familiarity on how you can get in and get out and what terms you should be familiar with. If you want to learn deeper, there's several free online courses out there on YouTube. You take all of these terms that we have and then you can go ahead. Any questions so far?
Yeah, Hercules Nathan here. So for beginner, right? So I don't have the margin account. So I think we need to have some minimum amount to get the margin account, right?
If it is a normal account, Nathan, you don't really need any, how do you say, you can just apply for a margin account. I don't think there's any restrictions that way.
Okay, but without margin account, we cannot do the calls and puts.
You can still do options.
We can still do options.
Right, just that they will not, yeah.
Yeah, only spreads I think they don't allow, because I have one, like for learning, I opened another cash account for options. So there that I can do call and puts actually. Right. So I still do in that paper trading, but yeah, we can do the call. But if we want to do spreads, for that we need margin account.
If you want to start basic, yeah, you don't need a margin account for that.
Okay.
We just need to call, I think, Nitin and call center, and then they will open your account for options.
Yeah. No, for TD I just applied and it was
online, right? Online it will.
Yeah, online itself, from the account itself I applied for options and it was immediately approved, and so I was able to do calls and puts for that.
Okay.
All right, so let's get a little bit into price action quickly, and then we can wind down our session today, unless you guys have any other questions at this point.
I think let's go to the price action. Yeah.
Price action is good. Okay, so this is the time where we could use some of the symbols that you have in mind to see if we have to take a look on which one's doing how. Then we will also see how the price action might work there. So let me go back to.
Your favorite is Apple. Huh?
Your favorite is Apple. Let's take a look at that one.
Depends on 15th what they're coming up. They're not coming up with iPhone. That's it, man.
Oh, nice. So you're in trouble.
Pargat made me nervous today. He said they are not coming up with iPhone. I said, hey man, don't say that.
Hey Anupam, you told me that they are coming with the 5G. Then I put one in the Apple. Don't tell me this is going on.
No, Apple anyway, it won't go down. I think that 110 price had very strong support, so it should not go down then.
It dropped from 137 all the way to 112.
Yeah,
right?
So I think it's still holding 110, so probably that's what we're hoping. It should not leave this one. But if the market is still weak, still may come down to around 98 or 100.
Yeah, that is where I go into the price action side of the story, where we look for market direction, because that's what I say. Market goes down. It doesn't matter how strong a company is. It just goes with the flow, right? So, which is where I would say market's going down, market direction, the numbers that we're publishing, the colors that we're publishing. If you go off of that, watch on that, be careful. If you have to do your own kind of position sizing, you scale out because the direction is low. It's always safe to do that. Right, and what Pargat that just mentioned is about the support and resistance zones. But once that zone breaks, Pargat, right there on that 110, 112 that you talked about, you never know how low it might go. Right.
Yeah. Right.
So let's go.
Yeah, it all depends, because Apple I just kept for long term, and I think entered last year. So because as long as it's there, or because I'm not buying so many, right? So I have few of them. So, and I got at a very good price. So, but if I sell and then I might not get chance to enter at the right price. So that's why for long term, I don't look much, but I stopped looking all those, these, any other indicators. I purely learning that technical analysis on support zone, resistance zone, and all that stuff. So.
Very good. All right, cool. So let's get into some of the pieces here on market direction. This is, we've always been watching daily. I try to publish this information, and trend lines is nothing but a standard line, right? You take a line here, and then you will say, how do you connect these dots? The different tops and bottoms, right? So if you do this, this is a trend line connecting from this top to this, this one. This is a very straightforward thing, but I will tell you when to use trend lines versus when to use channel lines. What I prefer is always a channel line for price action, and the channel line is nothing but, let's see if it is here. Yeah, parallel channel line, right? So if you take a channel line, I also have the tools here. In these kind of cases, if it goes sideways, we use horizontal lines and see how the breakout is. That's a breakout strategy. But if it is going downwards, you know that it is strong, but it is going downwards, you connect the two bottoms, right? You see bottom one and you see bottom two. You connect these two right here. Watch out, the bottom two is right here, right? Connect here and then go back and connect the top here. But within this time frame, if you extend this one, the price really crossed there, but if it, before that happens, what happened is this bottom formed another bottom here. So you keep connecting the bottoms. So what I would do is take this bottom here, connect it here. This will be a reasonable one to play with. But if you say, you know what, this bottom here, this chart is a little, that way you'll have to watch out for. But if you have to connect these bottoms here, right, and connect the top to this, this is where the breakout happened. This is where your entry will be for the long position. And then you will say, you know what, where do I exit? Your exit, once again, you can maintain the same thing. If this is your bottom, if it crosses this line, that means you are going to get out of your position. But if it continues to go up, you can move this line and say, here is my next exit. But as it keeps going up, when it falls down out of this one, you can keep moving this down line under here, right? But if you say, you know what, this is getting really tight, I want to be really sure that I don't want to go on a horizontal line, I can still go back on the channel lines and say, all right, let me connect this peak with this peak here, right? And find the bottommost point that all of the candles within that zone are within this particular channel. So as long as it is there, you continue. So now you take another one, right? Connect this top. And this is a very effective strategy without considering anything, without knowing anything in the market, right? This was your top, it's going all the way in, and this was your bottom. You could exit right there in that point, but again, get back in. But getting back in, we'll have to do that breakout right there with that horizontal line one more time in here and get back into the zone to get in. Now, how do you get out of this particular situation? Because that is where the losses came through. Pick up the next one here. This is the highest point up to this highest point, right? And then if you put your mark this way, touching the bottommost at this one, this will be, this area will be your exit position. When it drops that big and you don't want to sit through, you can just use that 8-year trailing loss, the yellow line, and just get out of it, right? In any of these things that you see here, if you entered right here and you notice that it dropped below that, and if you're not comfortable sitting, you got an option going on and you want to get out, you get out right there. Get back in right here if you're comfortable to get back in, and then you wait until this whole thing, then you can again get out here. But do we really want to get out in such short time frames? It depends on how deep you want to keep this 8-year trailing stop. If you make this one, instead of 5, 1.5, and this way you can always change this one to a higher number. This is like moving averages. Increasing these numbers from moving average 5 to a moving average 50 will make a big difference. So adjust these values. Now you see what happened? All of these values are inside the yellow line. So it depends on your appetite and how much you want to hang on to, and how soon do you want to get out? What should be a duration? Are you looking for a long-term kind of a thing? Then you stick to this, because all those candles are now inside that yellow line above the ATR trailing stop. So trend lines and the channel lines by itself is a very powerful strategy, as long as there's enough volatility in the market. If it is going sideways like that, it does not interest me much. You put a line there, you put a line at the bottom as the second line. Let me bring this down. And you wait for a breakout to happen between this channel. If you're trying to trade between these in and out, this is not a very good thing. You will be wasting a lot of time and energy and the capital right there and not make any money. So always watch for things that are on the move. Even on the last session, I was talking about those stocks that are not really moving. Don't put all your capital and get your capital locked into something that is not making a move. Find those that are having higher volatility and see how do you get into those moves. And then when that breakout happens from those that were not been moving, then get into those, and whichever direction it goes, then you go short or then you go long. And let's see what else we have on the price action. We talked about trend lines, we talked about channel lines, support and resistance zones, nothing but these horizontal lines that we put. The bottom line is the support line, the above one is a resistance line. If it breaks out support, it goes downwards. If it breaks out the resistance, it goes upwards, right? And generally, these lines are not really lines. These are zones. It can span with a few price levels there. So you have to really watch out if it's really a breakout on downward direction or not. The other one that I would also watch for is after the breakout happens, wait for a retracement to come through and then go on the short direction. Wait for a break, right? Even right here, right? Wait for a breakout to happen, right? And figure out where should be your entry point. There's only two indicators that I use for the most part. It is the ATR trailing stop and it is this MACD. And just for my own purposes, I came up with a derived version of MACD. If you see this arrows here, I only look at this one for divergence purposes, but this is my primary driver on MACD, where I call it like the retrace MACD. Look very carefully, all right? Ignore everything else here, price action and stuff, only MACD, because there is enough volatility on this one. You get in right here, short option, okay? Right here at this time, you shorted the market and then you got back in here long on the market, right? This was your profit in the short direction, then you got long here. What happened after that? Wait for this downward arrow, then you got out here, right? And if you're one of those that believe that Apple cannot be shorted, should not be shorted, just do the long. Get in right here, get out right here. So look at the amount here, 61.38 in about March or so, and you got out in the time frame of 79, right? That is 60 to 80, roughly $20 in 28th March. 28th May. And then you wait for a few until this thing settles in. Again, you got back in here, right? And you got out here. Once again, these indicators, right, can also be tweaked on how fast you want these arrows to show up. I don't want to get in and out so fast. I would like to hang in there a little longer. My appetite is big. Like Pargat was saying, he would rather prefer to stay there for a longer time. Increase this one, where the arrows don't show up that frequent. But if you're one of those for swing trading, these are my settings. I would like to get in fast. If the stock is higher price, get in fast, get out fast, get in, get out. Sometimes you might not make money. Sometimes you might have a small loss there. But look at this one, right? When it came through, you got in there, and look at the one before the market crash, exactly right here in these two bars, you're out. You don't take all of these rest of the losses here. Next time I see this green arrow going up, I can always get back in that one. Right, and let's see what else we have. This is another one, Fibonacci lines too, which is very popular. I use it sometimes, don't use it sometimes. Let's see how it is done. See, this is your bottom, this is your top, and this is your retracement, then again a pushback, right? In these kind of cases, what we could do is if you do, let's see, which one is this? I think it's this one. So you take this, give me 1 second here. I think it should be the same one here. Regression. Don't use this platform very much. So there you go. Fib retracement. So you take this one and you connect it here. You see the you can color the way you want it. If it hits these lines, right? I generally use it in a combination with another one, but Fibonacci lines typically say at about 50, 38 line, 50 line, and 61 line on retracement, they consider them too strong. But if it falls anywhere from 786, 78.6, right? And it closes below 78.6, then it is not a long trend anymore. If you notice this one, the resistance line or the support line that it hit here is 78.6, and it bounced back after that. So what I would do is I would wait for these 38.2, this 50 or 61.8, check when it hits these lines and see if there is a formation on another indicator or a price action on a channel to see if it moved up. So if you look at the channel here, it shows long. And if you look at the MACD, it also shows long. So we got confirmation. At the same time, we have another confirmation with the Fibonacci line, say it is a bounce out of 78.6 and is going to be a strong bounce. And that is where you can make that entry. And you can also time this one in a way, where do I take my profits? So if you remove this one and we'll say, there should be another one for extension. Trend-based extension, maybe this one. Let me see if this will work.
I think this one, if you do other way around, it will become that extension, the same one, I guess.
No, this is the extension because we want 3 points here on the extension. So if you look at the extension here, it started from here, went all the way up here, dropped here, right? What you're saying is also good, but that's only 2-point view there. This will be starting point. This is the high point. This is the bottom point, and see how far do we go. You can take your first take profits right here, your second take profit right here. The third one was right here. Let me see if I can write this down, but never hit the third one. So it was pretty close, did not hit the third one. This is how you can kind of scale out on your positions too and capture your profits as you're going along. Again, when this drops, do the same thing, right? And see how do you get in, get out. Depends on your strategies. If you want to do buy and hold, all of this obviously will not apply. But if you want to see when do I keep taking profits off, because if you look at it, for those that have been sitting on that, it went all the way close to this one, the 2.618 mark right there, but did not make it, but it dropped back to almost this point. This will now be your new support level. If it crosses the support level, then we have more trouble. This is the 108 level. So that's how price action is done. You try to eliminate as many technical indicators as possible because most of them are lagging indicators, and you just go off of the trend line, the channel lines, and the fib lines and make your entries in and out. Let's see what else. We talked about the technical indicators too. 2max, I use MACD. Mostly MACD is only for divergence purposes, and position sizing risk reward is critical. I've always talked about this one, not to go on each trade. Do not try to have a loss more than 1% to 5% of your account balance in each trade. And you will have to strictly monitor that one. If you take all the money, put it into one, and take all of the risk into one, then even if your rate of success is high, overall results are going to be low. One of them is going to drive it all down. That's why we need to limit our losses as much as possible to 1% to about 6%, sorry, 5%. And one of the other things people have that perception is if you take a $5,000 account, right, and you're not able to trade that $5,000 account to make it profitable, and then just because of some reason you think you change it to a $100,000 account, put more into that, and expect to make money, that's not going to work. If you're not able to make money on $5,000 account, your results are going to be even worse with a $1,000 account or with a $100,000 account. Right, so watch out on that, because once you get into that mode of losses, you will also see a lot of subscriptions where people say, you know what, we lost about 25%, we made 30%, 50%. The percentage that you will lose in order to make that back up is a very high percent to make that amount back up. So just because you got the first drop of 25% and the next drop of at least 30, the next win of at least 33% is going to bring you back to a break even. If you have to go, let's say, a drawdown of 50% and you have to come back to break even, you'll have to make 100% of that amount to come back to break even. So to go back to where you are will always become your next goal, not about making money. Every time you have losses, that's the first thing that goes in your mind. You say, how do I get back to where I started? If I have a $10,000 account and I dropped it to $5,000, then you will say, how do I get back to your $10,000? That will only become your lifetime goal now. And by the time you reach that $10,000 and now you're break even, now you lost your confidence to say, do I really invest now? I got my money back. So there's going to be all kinds of psychological things that will be running through. All right. Any more questions on the price action side of it?
So only one. Go ahead. Who was that?
Actually, I was wanted to ask the drive MACD. Is that available free one, or you change it or you customize?
Which one? This green and red? The green and red?
Yeah, drive Mac that like this one MACD one.
This one.
Retrace MACD?
Oh, this is nothing. This is few lines of code. So if you look at this guy, I use the MACD here. See, this is not
MACD also I just use for divergence because all these are lagging indicators. So I'm just concentrating mostly on the price action or lines.
Very good point. But see, if somebody really, this is nothing but the crossover of this MACD line, right? You see this crossover and you see this crossover right here. But I put a little bit of extra logic in there. So if you really have to see how many lines of code that is, it is simple. Where did that go? Here, right? So if you do, see, I even forgot how to get the fine editor. Let me pull this up here. And if you really look at the code, most of us are developers here, right? You start 1, 2, you see the number of lines here, with even considering the spaces in between, it's 40 lines of code. So that means probably 20 lines of code. Right. So not that I do a lot of programming, but I thought, you know what, let me stick this in, see how I want to explore the code here at the same time. It's called PineScript. And I wanted to see, because this is a very popular software in TradingView, I wanted to see how that coding works. So I said, let me build something very quick, right? And see how that works. See, if you go into TQQ, any other chart also, right? Same indicators there. See, I already have this Fibonacci thing lined up here. And if you look at this one, 1.618, exactly it hit that line before it started going down.
Yeah,
right. So this is the reverse thing that you're talking about, Fergal? I did not use the 3-point fib level.
Oh, okay. Yeah, this one, exact same one I have. I use that TD only, that Thinkorswim. So that's why.
Right. So that one also has that. But if you look at these lines again, right? The green after the green is a good confirmation. You get in, you green, right? You get back in long here. This green, second confirmation, get back in. here is a drop. And then if you look, when you see these closed ones here, this is where it'll help you with the, what do you say, the channel lines. So if you take a channel line here, let's see, this is your channel line. The more trading you do on a chart, the chart gets really clumsy, and it's normal. You get used to that. So once that drop happens, this is what happened in February timeframe, and this is where you enter. See, the MACD showed up earlier than the trend line. So as soon as this drop happens, if you're doing futures, you can go on the same day before the next market open and capture this gap also on the futures.
Oh, okay,
right?
okay.
So you take all of these things, and you see this MACD clearly pointing on 26th March, right there. That was your entry, and the next exit was right here, right? And if you're doing futures or options and stuff, this is a very good entry point right there and a good exit point. So this is a lot of money. While people are waiting for their recovery, on the buy and hold, guys, you made a lot of money in both directions. Look, this is your profit, and this is also your profit.
So only thing, Hercules, is this real? I'm seeing some lags in TradingView, but
lags in TradingView is because you're using the minute charts, and since you're not a paid subscriber in there, you will have about 15-minute delay or so.
Oh, okay.
Yeah.
Why? That is where I use my other charts on the NinjaTrader, that I have the data subscription on that. If I have to drop down to, this is more for demo purposes for TradingView, and it's nice, colorful, and all that stuff. But when you're really trading, I don't care about the colors and stuff, as long as it shows where my entry and exits are. Just keep
old school works better.
No, it's we are not a UI thing right here, right? There's no big presentation we need. All we need is direction. Yeah, but it's not old school on the other one, because the other one is more sophisticated because I have a lot more intelligence built in. If you look at this one, right? This is Microsoft on a daily. Okay. See, all these things that I have here, I have a bunch of intelligence already built in that I don't have to do. How many candles are part of this? What is the angle that it made here? What kind of rating does it have compared to the last X number of moves that happened? What kind of volume that went into this, right? All of this I've already put together as text in there, right? Because I don't really need any fancy stuff. This is all for myself. So when I see information of that kind, and the kind of volume that goes, the percentages and all that, I clearly know where is my next entry. You see this blue line is the same thing that I have on TradingView as the arrow that I showed you on the MACD, right? Yeah. Then I also have a lot of ratings here. See, look at that rating here. The rating is 4. 4 to 5 is the highest rating that I get. It's exactly like how Amazon has its ratings, right, on products. 4 stars, 5 stars, and how many people have really voted. If there is only one vote having 5 stars, it's not really a vote, right? Then you'll have to look for similar things here. How many people made this contribution for the voting to come up to 4 rating, 5 rating, right? Then I would say, wait for this retracement and then get back in when this arrow comes and look at that one. Yeah. Every arrow here is
retracements, or these the lines actually.
This one.
Yeah, these lines, those horizontal lines. Those.
These are again automatically done by the program. This is the fib lines that I put from the top to bottom. So I know these colors. The blue there is 50%. The other one is 38, and things like that. Well, once you go too deep, you don't know. You don't need numbers and stuff, right?
Right.
You know what each of those lines there are and what percentages they are.
Yeah, right. Yeah, that's why I'm all learning this one. That's why I'm trying to color code and remember what is that. So that's why I'm asking all these questions.
No, that's totally fine. And then the last thing before we wind down, this is always something that I show here. Anupam, you must be familiar with this too. This is how we do the comparison chart. This is once again on TradingView. This one does not need any data subscription and things because this is on a daily thing. Right now that I'm in, see, this one is XOP. This is what I published in the chat the other day when somebody asked, what are you short on? I'm short on XOP from a few weeks now. If you see, this one is it's simple. You have a start date, you put all the sectors and industries there and see which one is performing, which one is not performing, right? These are ones that are not performing, go short on those. And then you make your money, and you see these are dropping. get out of these positions and get into these positions in short direction. And then if you look on the right side here, when I bring the cursor on this point, when these things started dropping, it's at 6% or something. Now it dropped all the way to about 19% here. So 19 minus 6, 13% is profit right from early September onwards in 2 weeks.
So this is a comparison with SPY or?
Oh yes, this is the one with SPY, which is the baseline. If you see that shade there, that is kind of changing.
Oh, okay.
Right, that is where your SPY is, and then anything above that is that. So most of those, if you notice from this time frame on in August, right, if you see, as most of them keep dropping below the SPY, you will see signs of weakness already coming in.
Yeah, okay.
Right, not everybody was able to keep up with the SPY, and when SPY drops, right, all of them again continue to drop, get close to SPY, the squeeze happens.
Yeah, okay.
And SPY is always going to be somewhere mid, but if you see so many of them lined up below SPY, that means, trying to look for short positions. Some other symbols you guys had, I think one of them was talking about Nikola, right?
Nikola, it's quite down, I think.
You know what, not this one. Let me go on the other one. No, but we need to find an entry, right? Because we can make a blind shot and get in there. See, look at this guy here, right? The green one on April 20, it showed up this green, right? And then here is your exit. You probably missed these losses here, but you got out here. But when you got out here, you went short. When you went short on 26 June, you came back long again right here on August 6th. But then you got out right here again, that bounce and stuff. So this one's got a lot of volatility and gaps happening. Wouldn't trade that and pretty
But
frequent.
If on this one, right, so once it's turned down, right, the MACD crossover happened. If it goes to sideways,
then you get these kind of things, right? Then it gets noisy. Then you apply your support and resistance lines and wait for the right breakout to happen, and then look for confirmation on this one. See, look at this guy. What's this, Peloton? Look at the way the moves are, right? When it is volatile, high volatility in this way, look at the values here. Even before I apply anything, only these two indicators are more than enough without actually any kind of price action stuff. Green here, red here, that means, sorry, white here. You got out here. Once again, you got back in. You can get out here, right? Or you stick to this yellow line and just stay in there. I would use it for entry purposes, but use the yellow line for the exit purposes. We got out here.
It's kind of upward trend. So if it's not breaking, then yeah, we can keep staying.
Right, exactly, right? But these ones, if you're not comfortable, you can position your, you can scale out your positions, right? You got in here, you say, you know what, you got in here, you're enough, and then you'll say, you know what, let me get out of some positions, right? So these white things can give you indication to say, you know what, let me get out of some of my positions. I have a large position in the portfolio. So you get in here, it just gets a little sideways, safe side, you get out right here and wait for a new entry to come back in. But look, they took a big hit.
And this there. ATR, that trading, so that's also free one. I think Anupam also.
Oh yeah, these are all, everything here is free. Mine is not a paid account on this one.
Okay. And one question on swing one actually. So what time frame or chart time frame works better on that? Daily, 4 hour, 1 hour?
Or depends on volatility. See, on something like this, I would switch to a 1 hour chart. Right? If you're doing swings, this will be the one. See, if you look at August 26th onwards, from then on, moved up, you know where to get out. You would have gotten out right here and not gotten so deep. Again, get back in here. But see, these moves are pretty big. Right, these candles are pretty big. When you see candles that big, I will lower my time frame again. Right, you get out right here, you get back in, things like that. This is not a perfect example, but if you take anything,
it is highly volatile for last few days due to earnings, I think.
Yeah, my day trading chart, I go all the way to 2 minutes. So if you take 1 day and put the
No.
2 minute chart. Let's do 3 minutes because there's no 2 minute there. So if you look at this from here on, the drop happening, right? This is which day is that? 11th September, which is was it a Friday? So this is all one day, right?
Friday,
From here onwards. Look at the charts at this point. One of the reasons we would use trend lines versus channel lines is to connect the bottoms. So if you take this one, you did not do all of that. You just got in this. Right. Here is your breakout. Even if you missed out on this whole thing, here is a breakout to say I cannot go long anywhere. And then go this way. If for those that don't want to do ATR, don't want to do any of this stuff, you just want to stick to very plain moving averages, that is also fine, right? And let me also show you how do you do a moving average thing just to keep life simple. Which symbol was this? PTON, right? So if you go PTON on 2 minute, I'm going to pull out everything here, right? All of the stuff that I generally do.
And you prefer moving simple one or the exponential one? Or mix of those?
I do SMA. I don't do those DMAs and
Exponential.
EMAs. No, it's just simple moving average, right? So if you shift this to 2 minutes, and I will say PTON, right? This is my whole data feed and stuff. So this is this one. This is for which day was this? September 11th, right? All right. So here on top it shows that the date changes. This is all September 11th starting from, this is mountain time, okay? 7:30, which means it's your 9:30 Eastern time there. So if you see this one, this is the huge drop that happened. This is the moving average with the 21 moving average, right? So wait for it, and you can use this as one of those resistance lines. If it hits that point, right, on the moving average and then drops back in, when it closes, drops back in, right? When that close happens, you get back in, but then what is your stop loss? Now you put your trend line, horizontal line there, that'll become your stop loss. Once again, it hit there, you can increase your position if you want, get back in here, right? But you can also always bring this one down, right? But then this price has gone above the 21 SMA, the moving averages, and it dropped down. You can also apply your trend lines right here too. You say, let me take this bottom and let me connect to this bottom and let me put it here. This could be my place where I exit on my position. But if I have to get back in, I can get back in when the price closed here or when the price closed here, and then drop this guy again to this stop loss. Now you see this whole thing, you made all this profit. Now you take your channel lines again, connect to this bottoms here, right? And connect it here. You know where to exit if you want to exit. But you say, you know what, I want a re-entry again, all right? Do the other thing because it dropped, went up, dropped, went up, right? You connect these lines, connect the bottom, right? This did not cross. If you notice that it came down but did not cross, the cross actually happened here. Then you get back in here and then you move your stop loss back again here. So this is day trading. So you make money on some of these. One of them you gave out a little bit, but you can adjust these things. It does not have to necessarily hit this. You can always, if you're day trading, I would move this on a steeper move like this. I will immediately have another indicator also move somewhere around moving average 8 or 13 or so, and bring these down. Now you see this one, this is cross this. So your channel lines will get tighter because I'm trying to look for an exit. You see, the close has not happened here, not happened here, somewhere here. So my exit was right here. So I think one day I also published the chart on the day trading that I did in one of the charts. It gets really too many lines all over the place, but those lines are all in the past, because when this comes through in this zone, those lines are already done. You moved on, you executed those trades, and you don't bother to remove them. Once it's all done, you close it, it's all gone.
Main thing is, at least we need the margin account if we are doing a strict day trading, this kind of thing, like when the money gets immediately. Otherwise, it takes 2 days to get the money back.
your settlement, yes, that's correct.
Yeah.
Right, but
But
it
I think
also depends
Webull, I
on.
think takes 1 day. I think I heard that. I'm not sure, but
It only
Oh,
takes
Webull.
2 days, but this is again something else we would look.
Yeah.
There are rules around the whole day trading thing, right? Your
Yeah.
PDT and stuff.
Yeah.
See, the PDT applies your 25,000 limit and all that if you're doing stocks. But if somebody wants to do only futures, and
Yeah.
you have less than $25,000, and for futures, if you're doing one contract at a time, you don't have to wait for that settlement to come through. Right?
Okay.
Keep a margin account, and if you're able to do, then your PDT does not apply for the futures.
So in Peloton, right, at least I traded this before the earnings, and I was in profit because I looked at the trading view, the trail ATR trailing stop loss. I followed that path, and in the day trade, I followed the day trade method, and even before the earnings, it was going up. I exited out. I thought, because just same thing happened with DocuSign. I followed DocuSign, but DocuSign, because the market crashed the next day, on the day when it was although they were like a huge profit, but they failed because the overall market was going down. So no way it could push up.
Exactly.
So
That's what I say about market direction. You keep market direction as your guideline, your benchmark, and then you trade rest of them in that direction. If it flips, then at least in the first few days before the other ones recover, everybody's going to go down. Doesn't matter how strong of your reports were on your quarterly earnings and all that.
Right, but if you sell those stocks, right, because it has already dipped down by the time you realize, right, you have already made the loss. So what is the point of reducing your numbers? I mean, I know that it may go further down, it might go further down. It might go below 197, what we see now. But what is the point of taking that loss? Even like, I bought it at, like, let's say I'm giving you a number. I bought it $270 exactly when it was where it reached to 290, and then I bought it 270. I thought it might go up with the earnings, but market crashed after the next day.
Right.
Okay,
so your question there is, what is the use, right? Depends on how much you've lost. And then one other thing you'll have to watch for is, before you make an entry, that is where you need to make some of those decisions on how much you're going to lose versus not. But if you did not make those kind of decisions and you're strictly going by market direction, you get out and find a new entry, because the gap that you see, let's say you were supposed to get out right here, right, at 233, worst case scenario, right? And if you got out there and you make an entry after the turn happens, because you don't know how big of a move this is, you save up on your losses, then you get back on a fresh point for
correct.
For a new position, because psychologically it makes a big impact.
Right, because I saw even before the earnings, it went up to, because of the earning impact, it after market, it went pretty close to 255 range or somewhere that range. But then it, as soon as, the next day the market opened, it started falling down. So I could have exited out and, even taken a smaller loss and entered in at 197 or 190. And because it is still in downtrend, we don't know how down it can go, but it's a good company. Yeah, I mean, again, it's a good company. Yeah.
It is, but again, the point becomes, it does not mean the rest of them are bad companies that they all fail.
Exactly.
Right? So you get out and you find a way. That's why I say, don't get attached to a company because it's a good one. Right? See, here, the first time when I did the market direction published, let's say on September 2nd, 3rd, you see the weakness here. Let's say September 4th, right? Worst case. And if you got out, at least you will be out even of these. Sometimes you might think, I just got out, but the market started moving up. Yes, there is a risk of that kind that will happen.
Right.
But at least you protected further losses just in case it happens, because nobody ever knows what's going to happen, right?
Right.
So,
I mean, it all depends upon, if we get the vaccine in another month, then we should be good.
Right. That's the hope again. We don't want the strategy to be hope.
But elections are coming, so we never know.
Hey, I know I am betting on that. Trump is going to give us vaccine, and I'll be very happy after that.
There you go. Thanks for being optimistic there, but all right, cool. Any other questions before we close the session today?
I think we are good. I'm good.
You good?
Thank you.
All right, perfect. Yeah. So keep, if you guys are exploring options and stuff, post questions there. But if we want to kind of narrow it down, stick to maybe just a few symbols and see how do we trade, how do we enter, because there's a lot of things that's going on here. For example, on DocU itself, right? If you notice this one, this was a very good move all the way until this point, right? Now, can we monitor that? Keep posting symbols and say, does it look like it's a good entry? It's not a good entry, right? Right
Yeah.
now it's in the short position. When do we get back in, right? If there is no confirmation, I'm not going to get back in, right?
Yeah.
It may be good for you, may not be good for you. Some people might get the bottom and say, you know what, this is the perfect entry, and it is the perfect entry. But until I see confirmation, I'm not going to make an entry.
Yeah. One more company, Chevy, CHWY. I like.
Chevy, right, yeah.
Yeah, I saw in CNBC. I was seeing their CEO's
It's a big
interview.
one. It's a good
Yeah.
one. Yeah.
The stock is also not
Same
that.
pattern as DocuSign.
It had a big
right?
move. It had a big move and almost same move like DocuSign, right? So,
Yeah, it's a fundamentals are very strong for this company. It's a good one.
Say it was up 75, it dropped to 50.
Right.
So wait for the right move to happen. See right here, at this point is where this indicator is showing that you can go short. You don't necessarily have to go short, but wait for
a reversal. Yeah.
Yes, a reversal to happen, because overall their estimate was, it's still negative, but still surprises 0.9 cents is there. All right, sounds good. I'm going to stop the video at this point and we'll share the link.